I think we've got quite a nice participant group with us for this morning's session. So good morning, everyone, and welcome to this webinar session being co-hosted between Deloitte and the 274 Academy. For those of you who don't know me, I'm Chad, a member of the private markets team at 274. My primary role within the team involves manager selection and co-investment activities for the Black Business Growth Fund. If you want to find out more about what we do for the in the Black Business Growth Fund, please refer to our social media pages and our webpage for a bit around what the Black Business Growth Fund is about and what we're interested in. So this session is aimed at sharing some insight into the key accounting aspects of sale and purchase agreements and what should be considered when closing transactions during this current environment of uncertainty. It's my pleasure to introduce Claire and Mdu from Deloitte to you, who will be discussing the trends they've seen during this time with their advising their clients. Both Mdu and Claire have over 13 years of deal experience across multiple sectors, transaction types, and geographies. Claire in particular has extensive experience in advising clients on the accounting aspects of the sale and purchase agreements, a skill she developed in the UK and now applies within South Africa. You know, I find the views very informative. I hope you find the views informative and useful, and in how you should approach certain aspects in your deal making during this time. You know, during the session, we'll be posting some survey polls. So please participate, and my colleague Ridwan will be capturing these responses and providing feedback at the end of the session. We'll also be taking questions. So please add your questions via the Q&A button, and we'll look to answer these at the end through a panel discussion session between myself, Claire, and Mdu. I think if you can move to the next slide, Ridwan. I thought it'd be useful setting the scene before the session starts, and Deloitte gives you a bit of insight into SPA by looking at how the coronavirus is likely to affect private equity investment activities and returns during this time. With that in mind, what we looked at is the last crisis, which happened in 2008, 2009, and how the industry was affected. What's evident during the global financial crisis is that I guess PE quickly dropped off in terms of investment activity to levels 50% off the peak seen in 2007, but quickly again rebounded thereafter, but not to previous levels experienced. The same could be said in South Africa, where the decrease was around 45% from 2007 to 2009, but again to within 90% of 2008 levels. COVID-19 and the lockdown has certainly slowed down deal making, is what we're seeing in the market. And in part, this is due to, I guess, the disconnect between buyers and sellers around business valuations and uncertainty around sustainable earnings. However, in my view, this is the time, where a pandemic or uncertainty creates lots of investment opportunity. You've got to pick the right sectors. You've got to properly structure for those transactions, and you've got to take a bit more risk, I guess, within this time, this environment. There are opportunities out there. I think a lot of the managers that we are looking at now are very much focused on businesses that are accelerating the adoption of digital technology, businesses that are more annuity type in nature, and have been less impacted by COVID-19. On the next slide, what the global financial crisis has shown us is that I guess investments made post the crisis economic downturn are likely to do very well. If there's two things that I want you to take away from this chart is that across the top quartile, medium, bottom, and for the pooled money multiples, each one pre-crisis, post-crisis has performed better than their pre-crisis investments. So I think now is a great opportunity to identify those opportunities, take a bit more risk, secure those investments at appropriate entry prices, and with appropriate protection in your sale and purchase agreements. For institutional investors, I think the lessons of the financial crisis around the importance of vintage year diversification. If you go back up one, the vintage diversification to a downturn should hopefully mean that they are more inclined to make fund commitments to private equity now. PE funds with dry powder, in my view, are well positioned to take advantage of this current situation. And then finally, just to sort of, we surveyed a number of managers last year, the back end of last year. that are focused on the mid-market for their views on the impact of COVID on various aspects, including their investment activity. Some key highlights from the survey included that the investment processes have become more intensive. The evaluation of their pipelines in terms of liquidity, in terms of the appropriate levels of debt, sharpening the due diligence around assessing sustainable earnings, all have become a very important part of what they are doing now to assess the investment opportunity of a pipeline deal. Deals are taking longer. There's a lot more time taken to assess the impact on sustainable earnings as a result of COVID. There's more sector focus and certainly for companies that are really stable, that are stable and cash generative in terms of the industries that they are in. As I mentioned previously, annuity type businesses seem to be the flavor of the month. There is an increased focus on higher levels of return for the increased levels of risk of investing during this time. But more importantly, what we are seeing is because of the uncertainty around pricing and the challenges of finding common ground with sellers, many managers are effectively using innovative structures such as deferred consideration mechanisms to bridge that gap in value. The strategies applied on may not be new, but are reactive to, I guess, to this current environment. I guess the challenge with deferred consideration structures can ultimately is that they could lead to issues in the future between the manager, between the other shareholders, between the management teams, if not properly considered and catered for in upfront negotiations to avoid ambiguity down the line. What if there are unexpected issues post-investment? How do you ensure alignment across stakeholders for short-term gain versus long-term focus objectives of the fund? What industry-specific factors should you consider in your negotiation of the SPDA? What are the appropriate adjustments that you need to make to sustainable earnings? What are the normal levels of working capital that you need to be thinking about in this environment with supplier disruption? And how do you cater for what sort of entry multiples should be paying for business now? With that in mind, Deloitte should hopefully help answer some of these questions in the next section. And like I said, we'd be happy to take questions thereafter, and I encourage you to ask them. And yeah, with that, I'll hand over to Claire and Madhu for their input into the session.
Thank you, Chad, and thank you to 27 for hosting us today. Just as an introduction, we have an SPA team that sits within transaction services in financial advisory in Deloitte. We look at SPAs full time, both buy side and sell side across multiple jurisdictions and industries. We are specialist accountants and we are not lawyers. So we do not duplicate the work that the lawyers do, but we rather seek to bridge the gap between the findings that come out of the financial due diligence and make sure that value is brought into the SPA through the purchase price mechanics, the financial definitions, warranties, the completion accounts processes, and the leakage protection if doing lockbox, which is especially prevalent in the current uncertain environment. So moving on, just to, if we can, sorry, Ridwan, if we can just move to the next slide. Thank you. Just back one, thank you. So just to recap, we typically see transactions done on a cash-free, debt-free, normal working capital basis. So your enterprise value, which is usually done on an EBITDA multiple or DCF basis, assumes that there's no cash, no debt in the business. And when you take over the business on day one, you will be delivered with the fixed assets and a normal level of working capital that is required to generate those earnings or cash flows that you've assumed in your valuation. Of course, there will be cash in the business and debt. So there'll be a rand for rand adjustment for cash and debt that is acquired at closing, and there will be an adjustment for the delta of between your actual working capital that is acquired at closing and that normal level of working capital that's been factored into your enterprise value. We often see SPAs that define cash and debt with reference to bank statements or just very generic financial borrowing definitions. However, these definitions can be broadened or tightened depending on the business that you're looking at. For example, with cash, is all the cash on the balance sheet freely available to use to discharge your debt? Or are part of the cash, is it restricted or trapped? Maybe the business that you are looking at is in the retail space, and there is a certain level of cash that is used for cash floats. You can't use that cash to discharge your debt, that there's always going to be a level of cash in the business. And therefore, it's probably a better idea, or it's more that the cash floats is more quasi working capital rather than cash that you should be paying for rand. In a similar breath, like I suppose from a sell side, there might be balances on your balance sheets that are, for example, short-term investments, highly liquid, that can be translated into cash quite quickly. Sellers might seek to include those, get some value for that hasn't been factored into your enterprise value. There could also be some surplus assets, surplus land, for example, that they'd also want to seek value for and have some kind of adjustment. Towards the end of last year, we were helping a private equity company. They were looking to buy, or they actually did end up successfully buying a mall out of Nigeria. So it was a property deal. The valuation was linked to the value of the property, the value of the mall, but the seller came back with a list of additional assets that they wanted some kind of value for. So an additional adjustment. And we spent quite a lot of time considering how to best deal with this additional value that the seller was trying to extract from our clients. Also looking at debt. So of course, they're your financial borrowings on the balance sheet, financial liabilities, etc. But what about other balances that are debt-like in nature? Your CapEx creditors, your long outstanding creditors that are more financing in nature rather than working capital. How are you going to treat these? It might be better for you to take those out of your calculation of normal working capital and include them in debt, so you get 100% deduction for these. Again, there are some off-balance sheet liabilities and liabilities that only crystallize at closing. For example, break costs on debt that might be terminated, or transaction-related bonuses that also will need to be factored into your debt adjustment. There is deferred income that occurs in some businesses that we look at. Deferred income or income received in advance can sometimes be quite a significant balance, and there can be a debate on whether this is treated as working capital or as debt. We successfully managed to treat this as debt for a client who purchased a subscription-based business. So there were large deferred income balances at month end that was matched by cash received, and then the service was then delivered the following month, and the balance was around 200 million that we managed to shift out of working capital and into debt. Then moving on to the working capital adjustment. So the value is around setting the level of normal working capital. So for buyers, you want to set this as high as possible, and sellers, you'd seek to push this down to as low as possible. Mdu's going to go through a little bit more detail, specifically around the impact COVID has had on setting a target level of working capital. But we do often come across adjustments or adjustment mechanisms that exclude this working capital adjustment in its entirety. The risk really is that if the working capital adjustment is excluded from bridging your enterprise value to equity price, is that sellers might be incentivized to hold off on paying their creditors, collect all their debtors, so to boost their cash balance. This, of course, will impact on an increase in your equity value for that increased cash balance at closing. and then there'll be a working capital gap that will need to be funded soon after closing. And you, of course, as a buyer, are going to have to use that cash that you've just paid for, rand for rand. We've seen sellers manipulate balances in the run-up to closing, especially cash, and it's very tricky to prove that a seller has been manipulating balances. They always have very good excuses around their bad behavior, and typically they'll just lean back and say, oh no, it was just part of our ordinary course of business. Moving on to the next slide. We thought it would be helpful just to recap the differences between completion accounts and the lockbox pricing mechanics. So we've definitely seen completion accounts favored over the last 9 months, but lockbox deals still do make an appearance. So with completion accounts, you have your enterprise value that's agreed and hard-coded into the SPA when it is signed. And then your adjustments for cash, debt, and working capital are calculated through the completion accounts process, which your completion accounts are either drawn up by buyer or seller post-closing. And your SPA will include your financial definitions, describing what is in, what is out of those various adjustments, as well as a set of accounting policies that will be used to give some guidance on how these completion accounts will be drawn up. There are many myths around completion accounts. Some clients will just say to us, it's a process, we'll let the accountant sort it out, we'll just rely on IFRS, or, the accounts show a true and fair and accurate position. Why do we need a whole complicated completion accounts process? The reality is that real value is at stake. They're rand for rand adjustments. There is a range of reasonableness when it comes to applying IFRS for most balance sheets. So it's much better to be specific rather than rely on what somebody else considers reasonable. The completion accounts process can be long and drawn out, and therefore a distraction from the core business and the merger integration process. So having an SPA with prescriptive processes will be a quicker and easier process and an easier settlement around the adjustments. I'm currently dealing with a completion accounts process. I think we're sitting in month 14. And it's just because the SPA was quite vague around certain of the balances, and we're still trying to figure out how we're going to treat, for example, in this case, it's deferred tax liabilities. So we definitely believe that prevention is better than cure. So to have all of the steps and definitions well drafted and tightly drafted in the SPA will really create less headaches and areas for dispute along the line. So moving on to lockbox. Lockbox is where you have a fixed price, so that your equity price will be fixed and agreed before signing, and that will mean that your adjustments for cash, debt, and working capital are based on an historical balance sheet at the lockbox date. Your fixed price is then rolled forward to closing in order to compensate the seller for any cash profits that are expected to be generated during that gap period. Again, there's that gap period between lockbox and completion, and the seller will need to give the buyer protection, especially over leakage, affirming that no leakage has occurred during this period, no extraction of value to the seller or to a seller's related party. Now, leakage goes beyond just your dividend payments, management fees, or loans made to the seller. I'm currently working on a leakage dispute where there are a number of asset stripping atrocities which have been uncovered by the buyer after they took over the business. There are bonuses paid to various of the executive management team that form part of the sellers group. And this is in excess of $3 million. Personal expenses by some of the sellers, the individuals who make part of the sellers team. They were in excess of $4 million, write-offs of loans, where there was a loan on the at the lockbox balance sheet, and this was subsequently, the nature of the loan was changed into a prepayment and then expensed through the income statement. There was an arrangement fee of $8 million during the lockbox period that was paid to one of the sellers, the entities in the sellers group, for loan origination in the target entity. And travel expenses, private jet fee costs for carting one of the sellers to his house in Milan. So you can see that definitely leakage must be broadened than just your general dividends and management fees to be able to capture all other value extraction that might occur. For lockbox, it's only appropriate if you are buying shares. So if you're buying a legal entity, so you can actually lock the box around what is being acquired. If you are looking at an assets deal, your movements between your assets and liabilities will change on a day-to-day basis. It's very difficult to track those transactions between a lockbox date, so a historical balance sheet date, and closing. Because also with assets deal, typically you'll leave behind the majority of the liabilities. You'll only assume the liabilities that are linked to those assets and employees that you might be taking over as part of the transaction. Lockbox is a great way for sellers to compare bids in an auction. It gives value certainty for both buyer and seller, and is very well favored amongst private equity houses. You need to watch out for carve-outs and reorganizations. So if there's a reorg or carve-out, this is best to be done before the lockbox date. If it's done after the lockbox date, you're going to have to overlay those transaction steps over that lockbox balance sheet to make sure that they've been factored into that fixed price that you are paying for the business. We've seen bad lockboxes in the past. Last year we were working for a large retail company that was asked to put a bid in on it was a lockbox basis, and they needed to use a balance sheet. So the lockbox date was 31st of March 2020, and we were doing the work. Now it was like January, February this time last year. So it was a future balance sheet. Can you rely on the seller and the target management's forecast balance sheet? And especially this was just before COVID. So, our client walked away from the deal. And I think most importantly with lockbox really is around, is there adequate information to be able to price properly? Can you do it? You need a robust balance sheet in order to be able to rely on those numbers that you've used and taken into account for your adjustments for cash, debt, and working capital. There's no opportunity to adjust the price post-closing. We see companies where they only do a hard close, proper accruals, provisioning, calculations of tax balances, etc. at year end. So it might be appropriate that to have your lockbox date coincide with the company's year end. But some companies are able to provide you with a proper balance sheet on a monthly basis. It just really depends on the financial reporting of the business that you're looking at. So moving on, so the implications now with completion accounts in light of COVID. What does COVID mean for purchase price mechanisms? As I mentioned before, we have definitely seen a shift back to completion accounts with opportunistic and strategic plays. There have also been a lot of asset carve-outs, often bilateral, as corporates seek to shore up their balance sheets and divest non-core assets, and buyers look for opportunistic and strategic acquisitions. And we've seen this specifically in the telecoms industry over recent months. So looking at your accounting policies and how these will adapt, often reliance is placed on your completion accounts will be drawn up on a consistent basis with the last set of statutory accounts. But what if your last set of statutory accounts were, for example, February 2020? So are the accounting policies used in those financial statements, are they appropriate to be using now when you're drawing up your completion accounts. Might be less relevant. We also have seen, and we have definitely recommended prescriptive policies around certain judgmental and subjective balance sheet items. So for example, your receivable and inventory provisioning. And also we see sellers really trying to defend value through the completion accounts policies. So limit of balance sheet liabilities and those liabilities that are unlikely to crystallize at closing or soon after. And also look to how they can include the surplus assets, as I discussed earlier. So what if deals were signed pre-COVID-19? You will be bound by the clauses and the definitions, etc., that you have in your signed SPA, which obviously we expect will increase a contentious process, especially when there is value at stake. So as advisors and parties to the agreement, you're going to have to come up with very innovative arguments to support your case on why items should be included or excluded or additional provisions raised, etc., when it comes to determining your purchase price adjustments. We were at this, so this kind of time last year, we were assisting a overseas seller. So they had sold a local South African brewery company, and the deal signed in October of 2019, and the deal ended up closing on the 31st of March 2020, so just a week after hard lockdown. So no one could attend the stock count. There was an alcohol ban. Nobody knew how long the lockdown was going to go on for. The parties had to reconsider their valuation of inventory and their inventory provisioning, because beer, of course, has a limited shelf life. The buyer was under severe financial constraints, but the seller was adamant to get the deal done. So they ended up giving the buyer a vendor loan just to get the deal over the line. There've obviously been practical implications of lockdown. So travel limitations, people aren't able to do face-to-face meetings, they're virtual negotiations that do impact how negotiations end up going. So we also have seen extended and flexible completion accounts timetables, especially with bilateral processes. These tend to be slower, as parties do tend to proceed more cautiously. So what are the new potential focus areas? We've seen a lot of shortfalls in discretionary spend, especially around CapEx in the last probably nine months, as we've been looking at deals. They've been, companies are under cash constraints. They've been putting CapEx projects on hold, waiting to see, what the impact of COVID will be on their bottom line. And so buyers have had to also have a general level of acceptance that there have been shortfalls in this discretionary spend and factor it into their valuation rather than seeking a debt adjustment. Also consideration around loss-making contracts. Are these short-term? Are these long-term? How will these be factored into your valuation model? Or will you just rather look to get an adjustment off the price as a debt adjustment? Onerous leases are especially prevalent in the retail industry, with retailers reducing their number of stores, and how will these be treated through enterprise value adjustment or debt. We've also seen where there have been insurance proceeds received due to COVID. How will these be dealt with? Sellers will want to get value for insurance proceeds, but the buyer will look to exclude insurance proceeds, as these have been required to make the business whole. So moving on to implications for lockbox purchase price mechanisms. So with lockbox mechanisms, as I mentioned before, you require a robust balance sheet, and this becomes quite problematic where historical balance sheets are at risk of becoming obsolete. Trade receivables may no longer be recoverable if there's been a deterioration in the financial health of your customer profile during the lockbox period. Inventory may be exposed to lengthier cycles. There could be new balance sheet liabilities that have been triggered, redundancies, onerous leases, purchase commitments that haven't been factored or weren't there at your lockbox date. And you need to consider how these are going to be priced in or dealt with through the SPA. So with lockbox, obviously the key is around doing proper due diligence on that lockbox balance sheet. So can this be done, and the impact on the timetable around being able to perform proper due diligence, working remotely, etc. So even if a lockbox balance sheet is unaffected, you need to be comfortable that you've done sufficient diligence and you can rely on those prices and on those balances in that lockbox balance sheet that impact your fixed price. Then the feasibility of the mechanism really comes to assessing the profits that are generated during that lockbox period. So with unpredictable profits, it might mean it's difficult to agree that interest rate that gets applied to your fixed price. A buyer is going to have to rely on the seller or the target management's forecasting techniques and forecasting assumptions that might be put under pressure due to COVID-related uncertainties. And have you been able to diligence these assumptions that have been used in the forecasts? Also, with Forex and commodity price volatility, if there's been significant shift in these in FX or commodity prices that result in erosion of value on the balance sheet, it might mean that lockbox is not an appropriate approach. So what are your options really if you decide that there has been a significant change since you use that lockbox balance sheet? Well, you can defer the process to a more current balance sheet that you feel that you can place more reliance on, or potentially switch to completion accounts. And we have helped clients on transactions recently where even in auction processes where it's come, you've received the term sheet or SPA and it's been on a lockbox basis, and our clients have just turned around and said they cannot accept the risk associated with not knowing what's going to happen between now and when you close the deal, and they've switched to completion accounts. I'm now going to hand over to Mdu, who's going to take us through other considerations that we usually help out on SPAs. Thank you.
Thanks, Claire. So in the current environment, there are particular deal terms that require particular attention and consideration just in the COVID environment that we're all operating in. So in this session of the presentation, we'll specifically be talking through earnouts, target working capital, warranties, and the material adverse change clause. In terms of earnouts, in view of the market volatility caused by COVID-19, buyers and sellers are more likely than ever to find difficulty aligning on valuation. This is particularly the case for businesses that have been severely impacted by COVID-19. So as Chad mentioned earlier in his opening remarks, a way to bridge this valuation gap is through the use of earnouts or a deferred compensation mechanism of sorts. Going into Q2 of 2020, many M&A experts were predicting that there will be a rise in the use of earnouts, just as a way to bridge that valuation gap. However, we did have sight of some research that was conducted by DLA Piper that show that although there was an increase in the earnouts, the increase was not as high as expected. In our view, I think this is particularly because still trying to agree on an earnout arrangement in an environment where the foreseeable future is still fairly uncertain is still risky. And some buyers have rather opted to either put the deals on hold or walk away from the deals completely. In the deals that we have worked on since the pandemic started at Deloitte, we have not seen an increase in the use of earnouts. And also we have not really seen a lot of deals where earnouts were put on the table. And also, I think this could just be a function of, the type of clients that we're working for, because a lot of the clients that we've advised in the past couple of months have mainly been trade buyers. So, the use of earnouts has not been that prevalent in a lot of the deals that we have worked on to date. In terms of target working capital, setting target working capital for a business that has been impacted by COVID is extremely challenging. There's a number of factors that need to be thought through in trying to get to a reasonable answer on what the target working capital of the business should be. So things to keep in mind are, for example, or things to think through is, is the past an appropriate measure of the current and future normal working capital of the business? And if you are looking to normalize the working capital of the business, you need to think through what type of normalization or once-off adjustments you need to process against the working capital. Ultimately, one would need to take a view on whether or not COVID-19 has had a short-term impact on the working capital, or if it's had a long-term impact on the business. If the view is that COVID-19 has had a short-term impact on the business, it may be advisable to use the pre-COVID-19 numbers to set your working capital target, because those numbers will most likely be a good proxy for the business that you're taking over. But if the view is taken that COVID-19 has had a more long-term impact on the business, or the landscape in which the business operates in has changed fundamentally, then one would need to look at other ways to set the working capital target, because using historical or past numbers may not be an appropriate measure. In our experience, in terms of the transactions that we've worked on to date, we've seen a bit of a mix, but the majority of the businesses that we've diligenced, the impact that working capital had, the impact that COVID-19 had on those businesses was temporary in nature. So in those instances, we were able to clearly see and isolate the impact of COVID-19 on the numbers and on working capital specifically. And where information was available, then we were able to then normalize working capital for the impact. So some examples, in some instances, we saw companies increasing their bad debt provisioning because customers were slow in making payments. So companies would increase their bad debt provision. In some instances, you saw a stock buildup where companies weren't able, where the sales deteriorated, and then there was a stock buildup. So again, just in terms of the types of adjustments you would process for working capital to cater for the COVID-19 impact, you really need to treat it on a case-by-case basis and really understand what impact COVID-19 had on the specific line items. I think from the key point to take away around this target working capital issue is that you don't want to you want to ensure that you are not losing value in your bridge between enterprise value and equity value by setting a working capital target that doesn't match the valuation that you've given the business. Just moving on to the next slide. In terms of warranties, we expect that additional warranties would be required, providing comfort around COVID-19 related matters specifically. However, sellers can limit the amount of warranties by providing quite extensive pre-closing disclosures regarding COVID-19 matters. And then in terms of warranty and indemnity insurance specifically, at the moment, our view is that the current market practice is that most insurers will exclude losses related to COVID-19. So unlikely that you would get warranty and indemnity insurance covering COVID-19 losses. And specifically around, what the insurers would be looking for around warranty and indemnity insurance is they would want to get comfort that, the parties to the deal have proactively dealt with any potential losses that the business may incur related to COVID-19. In terms of other focus areas that they may be looking at, it's more likely that they'll be taking a greater look and focus on things like projections, business continuity planning, security of supply, and the ability to exit or terminate material contracts without penalties. And then another area that they'd probably be looking at is making sure that the parties to the deal are addressing the risk of COVID-19 worsening between the time that the deal is signed and when the deal closes. Just moving on to the point around the MAC clause or the material adverse change clause. So in the seller-friendly environment preceding COVID-19, the MAC clause was quite rare, but just given the current situation, buyers will most likely be looking to revisit the MAC clause or be looking to include the MAC clause in the sale and purchase agreement so that they can get protection around the risk of COVID-19. However, it should be noted that generally the MAC clauses exclude events that have broad market impacts, such as natural disasters or other acts of God. So these are the types of exclusions that sellers would be looking to use to make sure that buyers don't walk away from a deal where the seller's business has deteriorated due to the impact of COVID-19. Ultimately, a lot of negotiation would have to take place around the MAC clause to determine whether the material adverse change is a business-specific risk or if it's a general market risk. Sellers will most likely contend that COVID-19 is a well-known market risk, which should not be covered by the MAC, whereas then buyers will look to not take on that risk entirely. Look, in our view, this is a clause that sellers would most likely be pushing back on. So a lot of negotiation would need to happen, to get this clause over the line. If you're a buyer looking to include this clause in the agreement. Yeah, in closing, look, there's no doubt that transacting in the current environment is extremely challenging, given that given that we're all unsure how COVID-19 is going to play out in the future. Having said that, M&A has shown quite a lot of resilience, especially just looking at the activity in the second half of last year. And deal makers have started to get comfortable with navigating, transacting in this environment. And as the Deloitte SPA team, as Claire's mentioned, we have started assisting clients think through the implications of COVID-19 on some of these terms. You know, and as the Deloitte team, we are well placed to assist you think through those issues as well. So now I'll just hand over to Ridwan to take us through the Q&A session.
Great, thanks very much, Ndu, and thanks to the panelists once again for that session. Before facilitating the Q&A session, we do still have a couple of minutes before the session ends. So I'll just quickly recap on the poll responses that were asked, just to share what those responses were. I do encourage all the attendees to pose your questions through the Q&A or chat so that those can be asked. In recapping the poll responses that we got, question 1 was, have you previously included a net working capital adjustment to equity value in a previous transaction, yes or no? We had 77% answering yes, in that they had included a previous net working capital adjustment to the equity value bridge, and 23% answering no. The second question was, what has been the preferred pricing mechanism in your last 5 transactions, whether completion account or lockbox? 63% of responses were completion accounts, with the remainder being lockbox. Before getting into the questions, I do want to pose that to the panelists. One of the questions in response to that poll that we had come through from Sylvester Albani was and we had initially discussed the possibility of including a hybrid of these mechanisms. What has been your observation of that? And I think what Sylvester specifically notes is that particularly in the listed environment, even if you use completion accounts, you'll still put a hard maximum limit on the value of transaction, else you'll run into a category 1, category 2 transaction issue. I guess the first point is just discussing around your views around how binary that is in your experience with transactions, and where you've seen a hybrid mechanism incorporating both completion accounts and lockbox. Claire, should we start with you?
Yeah, I mean, we have seen hybrid kind of mechanisms in the past. I think just to note, I mean, with listed, when you're buying into a listed company, you're not going to have completion accounts, because you can't kind of take those completion accounts adjustments and spread them across the various shareholders who you're buying from. So in that sense, you'll have a fixed price per share, and that in a sense is lockbox. It's where we do see hybrids, we try and understand why there's the need for some kind of post-closing adjustments. If it's a very straightforward lockbox process where there's not a long gap between lockbox date and closing, we'll kind of ask the questions around why we can't just use a straight lockbox mechanism. However, with for example, where there's a lot of regulatory approvals that are required, and the kind of that gap period becomes longer and longer, it could be we have seen in excess of 18 months gaps between lockbox date and closing. Really, sometimes the mechanics do change along the line. I'm actually working at the moment on a kind of a post-closing dispute where it was a lockbox mechanism. It did change, even though they did sign the SPA. There were various amendments to that SPA along the way, as the kind of gap between lockbox date and closing became longer and longer, and there was more, there was so much more things that happened in the business during that time, various acquisitions, disposals of businesses. That lockbox balance sheet was quite different. The business was quite different when they ended up closing the deal as to when they originally looked at that balance sheet that was 18 months old. I don't know if anyone else, Chad, if you have anything to comment.
Yeah, maybe just to sort of, from my experience, what I've seen in the past is that one of the transactions I worked on is we did have a hybrid sort of mechanism, and that was primarily because you could, as Claire sort of mentioned earlier, lock the box around a particular business, because there was an entity that you could diligence, you could look at the relevant balance sheet. It was a relatively straightforward business to understand, but on top of that, there was a carve-out acquisition coming across as part of the combined acquisition or combined structure, and that at that stage was still very much needing to be needed to be separated from the broader business, and so there was I guess a mix or a hybrid approach taken in terms of that particular transaction, and the application was more completion accounts, I guess, on the carve-out part that came across.
And I think I mentioned that carve-outs and reorgs are always a bit of a red flag when it comes to lockbox deals.
Yeah.
Thanks for that, panelists. The next question is just getting your views on the main areas of dispute on an SPA, particularly after closing. And I think, again, perhaps, Claire, you want to share your views with us, and then chat maybe from a mid-market perspective what your exposure has been or experience has been, particularly in with regards to the areas of dispute, and whether there's a need for flexibility given the nature of the mid-market space and transactions. Partnering with entrepreneurs is often something that needs to be given thought to, and obviously thinking about clauses that are built into the SPA.
Yeah, Ridwan, I think where the SPA doesn't give a lot of guidance as to how the completion accounts should be drawn up. For example, we've been asked to get involved in completion accounts processes where we haven't been involved in the SPA side. So the drafting and the input into the SPA. So the SPA will have been signed. The deal will have completed, and the only guidance will be referred to IFRS. And so, the preparer, so where we've helped prepare the completion accounts, we will do or we will apply, our kind of version of IFRS based on how the accounts were previously drawn up. But of course, that will be to the benefit of, you'll kind of push the boundaries, so to speak, to be to the benefit of your client, whether, where in this circumstance it was a buyer. And then that typically will end up in quite a protracted negotiation between the two parties to try and end up settling on what those adjustments should be, because there's no documentation to go back to say this is how we're to deal with receivable provisioning, for example. So it's really around vagueness in the definitions and vagueness in the process around how these accounts should be drawn up.
Great. Thanks, Claire. Next question coming from one of our attendees is that we've seen that deal activity, both PE buyout and M&A in the US and UK rebound at the end of 2020 already to almost record highs, which hasn't seemed to come through emerging markets as yet. Do you see this trend coming through in South Africa and on the continent as well? And if so, whether at the same pace as what we're seeing in the US or UK, or more likely to be on a more muted basis? Chad, should we start with you on that one?
Yeah, I think, I see it's a question from Jason. Long time since I've spoken to him. The rebound, I guess, I can't really speak to. I haven't really been following what's going on in the US and UK, but I know there's quite a lot of dry powder out there, and I guess like I said at the start, I know a crisis creates opportunity. So there's probably a lot of businesses that are stretched in terms of their balance sheets and needing capital to plug that hole. Locally, what I can say in South Africa, I think there's lots of deals out there that need capital. I think the challenge a lot of the managers are finding is that it's just and the way the industry is structured is that it's just hard to get consultants and pension funds, frankly, to actually, spend a bit more time looking at what private equity can give you in terms of returns, in terms of how these vehicles are structured and why these managers are good at what they're doing. I think that's really the challenge. I think there's limited capital out there, and there's lots of deals. So, and as a manager, you have time to sort of, you have time to take, if you've got dry powder, you've got time on your hands to pick the right deals. What I would like to see is, I guess, managers taking a bit more measured risk in terms of in terms of executing on transactions. But I guess until there's more competition in the market with capital to deploy, I think you're going to see a bit more of a muted trend come through. But saying that, we are seeing a lot more activity on the consultant side, on the pension fund side, looking at private equity as a way to sort of accelerate or improve the circumstances, I guess, SA is currently in.
Rids, maybe if I can add, I mean, what we've seen from where we're sitting as the, I guess, the transaction support advisors or the diligence advisors is, you know, I guess maybe starting from June last year, we have seen that, you know, clients are transacting or are looking to do deals, just based on the number of, I guess, engagements and proposals that we are engaging with on clients. So clients are definitely looking at transactions, but what we have seen is that, you know, clients are taking a lot longer, or firms are taking a lot longer to actually start and commence and follow through on actually transacting and, you know, pressing the button on, you know, doing the diligence. I think part of that is mainly because I think firms are probably still grappling with valuation. So, you know, because, you know, going into the diligence, you know, you'd want to kind of have a handle on the valuation that you've given the business, and then as you going through the diligence, you're really just kind of kicking the tires to validate the assumptions that you've made on valuation. Yeah.
Okay. Thanks for that, Ndu and Chad. With the final 2 minutes, I do want to hand back to Chad to sort of round the session off. But thanks again to the panelists for sharing their insights, and to the attendees for attending and posing your questions.
Well, thanks everyone. So yeah, I guess in sort of in closing, just want to say I hope you enjoyed the session. I think there are some questions that we haven't answered. We would look to get answers from ourselves and also from Deloitte, and then we'll post that on our social media pages. The recording of the session will also be available within 24 hours on our social media page. I'd like to thank Deloitte. I'd like to thank Claire and Ndu for their input and insights. It's been very informative, and I hope, again, like I said, insightful for the managers out there. And I guess in closing, I'd just like to say, stay safe, take care, enjoy the beach for those that can, and drink responsibly, finally. Thanks.
Thank you, Chad. Thanks, everyone.
Thanks, everyone.